Well, the Federal Reserve sets interest rates, manages the money supply, and regulates financial markets. But tomorrow, the Federal Reserve meets up for day 2, and there's expectations that interest rates might get hiked up again. Nixon, what could this potential increase in interest rates mean for all of us?
Kanisha, the Federal Reserve raises interest rates in order to combat inflation, which unfortunately we've seen a lot of in the recent months. And although these higher interest rates may even things out in the long run, it doesn't mean we won't feel the effects of this hike now.
Forecasters predict that the Federal Reserve will boost federal interest rates by at least another 0.75%. This would mark the 3rd consecutive increase of this size and the 5th overall rate hike this year. But what does this look like day to day? Well, let's do the math. Every 0.25 percentage point increase in the Fed's benchmark interest rate translates to an extra $25 a year in interest on $10,000 in debt. That means a 0.75 percentage point hike on Wednesday would deliver an extra $75 of interest for every $10,000 in debt. But why do these rates need to be raised in the first place, you may ask? Well, it's to gradually reduce the amount of money in circulation and make it a little harder for people to borrow and therefore spend. These higher rates encourage people to do both of those things less, which results in leveling out inflation. Again, which in the long run is good, but for now, if interest rates are increased again, you can expect higher interest rates on your mortgage, car and business loans, credit cards, and more. On the bright side, though, these higher interest rates also encourage more saving, because when interest rates are higher, your savings can really stack up.
So what can you do? Experts say the best thing you can do is pay off high interest rate loans as fast as possible to minimize the long-term impact on your wallet. Back to you, Kanisha.